Quiero en este momento dar la bienvenida a nuestra siguiente conferencista. Ella es Katharine Pulvermacher, directora del Microinsurance Network, quien compartirá con nosotros los resultados de la publicación El Panorama de Microseguros de Latinoamérica. Creo que el micrófono de Carlos sigue encendido, por favor, ¿sí? Si lo podemos apagar. Gracias. Y damos entonces la bienvenida con un fuerte aplauso a Katharine. Muchas gracias por acompañarnos.
Buenos días. No hablo español por ahora. So Dirk has 10 years on me, and I hope you'll forgive me for speaking to you in English this morning. I'm going to try to speak slowly as I can about this exciting topic, and for us, what is a very exciting launch of our annual report on the landscape of microinsurance. But before I get to that, I would like to say a very warm welcome to all of you participants who are here today, because you are the ones who make this possible. If we had events and no one attended them, we wouldn't be doing very many events. And the fact that you're here today is an indication for us of the interest, the continuing interest, as both Dirk and Alejandra have already alluded to, of the financial community and the insurance community in inclusive insurance and in microinsurance. So thank you very much for being here today. I'd also like to thank our co-organizers and sponsors. First of all, a very big thank you to Fasekolda and especially to Alejandra and Oscar, who have put in many hard hours of work to organize this event and make it possible. Alejandra is also one of our board members at the Microinsurance Network and commits a lot of her time to that activity as well, so a big thank you for that. A big thank you to Dirk Reinhardt and Munich Re Foundation, who for many years now have been supporting the development of a pro-poor insurance market around the world, and who are co-publishers, along with the Microinsurance Network, of the landscape on microinsurance. I'd also like to thank our other partners for this event. So Micro, who is organizing the workshop on Thursday and who is also a member of Microinsurance Network. The International Bank of the Inter-American Bank of Development, IDB, BID in Espanol, Banca de la Oportunidad, and many others who have contributed along the way, including my team back in London. So I think if we can pass on to the slides. Here we go. Today we're going to talk about the launch of our annual report, as I said, and this year the focus has been on Latin America and the Caribbean. This research is made possible by the many sponsors that you can see up here. Again, an indication of the support of both industry and donors for this kind of project, which exists for reasons that I'll go into. But let me thank each of you by name. First of all, AXA Insurance, who was a very generous sponsor for the work. ADA, which is an NGO based in Luxembourg that supports many financial inclusion development projects and has, in fact, a project in microinsurance. Fides, who is known to you all. The German Ministry of Cooperation and Development, GIZ and BMZ. Sura, who is also a sponsor for this, and most especially the government of Luxembourg, who makes the existence and continuing existence of the Microinsurance Network possible through core funding. The work was carried out by H2F Consulting, who were employed to carry out this project for us last year on behalf of the MIN and Munich Re Foundation. And perhaps it would be worth just telling you a little bit about a microinsurance network, just to begin. We are a not-for-profit organization based in Luxembourg, and we are a global network of insurance experts around the world who have an interest in seeing pro-poor development of the market, specifically with respect to microinsurance, but increasingly looking at other forms that will benefit the ultimate beneficiaries, who are most recently termed as emerging customers. What brings all these different stakeholders, who range from regulators through to donors, through to implementing agencies, through to insurance companies, both traditional and those specializing in microinsurance, as well as universities and think tanks, and the many other service providers that make up the value chain, is a single vision. And this is the development, as I have already said, of a pro-poor insurance market. What does such a market look like? In some ways, it's very simple. It's a market that brings value to service providers, so the business case and the efficient business case is important, but also brings value to the consumers that it serves. So what about the landscape studies on the world map? These studies are now in their 8th consecutive year. As you'll see, they started out, actually the first one was done some years back. And the purpose of the studies is to collect and collate data on the coverage achieved through microinsurance products around the world, providing, in effect, the industry's only benchmark. We know that access to data generates market knowledge and development. It also furthers best practice and leads to better products and services. So we need reliable, accessible data in order to support the development of inclusive insurance around the world. I mentioned that this is a project that has been going on for some years, and here you can see a timeline. So the very first landscape was actually carried out in 2005, 13 years ago, and in those days it had a focus on the world's 100 poorest countries. We then resumed the studies back in 2010, and from 2010 to 2016, these were implemented by Microinsurance Center, now Microinsurance Center at Milliman, who may be familiar to you, to many of you sitting here in the room. And an effort was made to widen, to focus the studies on one region at a time. For the last few years, we focused on one region per year. And so last year, 2017, the focus was Latin America and the Caribbean. And this year, in 2018, we are focusing on Africa. What are the headline figures? So in your packs, you do have a copy of the report in Spanish. We have also just launched the report online on our website, and you can download soft copies there, both in Spanish and in English. But the headline figures show that, based on our research, by the end of 2016, just over 52 million lives were covered in the Latin American region. I will call it the Latin American region. I'm talking about Latin America and the Caribbean region, of course. On average, throughout the region, 8.1% of the total population was covered, and the total value of premiums was $480 million, so $500 million. Now, a bit of context. We know that the region had its first 2-year recession in 2015 and 2016. It was the first time that something like this had happened since the debt crisis of the 1980s. This sharp economic slowdown, which didn't affect all countries equally, has also been mirrored in the region's insurance sector. So we've seen Overall, insurance premium growth, inflation-adjusted premium growth, slow from 5.2% in 2014 to 4.6% in 2015, and still remains below the rates seen before the financial crisis. When measured in US dollars, premiums for the Latin American and Caribbean region actually fell from 178 billion to 158 billion US dollars, but much of this was a currency effect. And you'll see in the report that we have made a reference to this because many of the figures, for reasons of comparison, are presented in terms of US dollars, but it is important to note that this does mask a significant currency depreciation across most of the region between 2013, when the last study was carried out and published in 2014, and the study that we are launching today. We also know that microinsurance premiums across the region represent less than 1% of the insurance market. So we believe that there is substantial room for growth for this segment of the market, particularly when we take into account that insurance penetration of the general insurance market across the region is rather low. So, for example, for the Latin American and Caribbean region as a whole, Oxford Economics, Oxford Business Group reports that insurance penetration stood at just over 3% in 2015, and premiums per capita or density stood at $251. We also know that the development of the insurance sector varies greatly within the region, and that Colombia, in fact, has one of the larger insurance markets. It's also important to see microinsurance and the development of the market in the context of poverty. So microinsurance is a market segment that has been developed to support those trying to exit from poverty or who have just exited from the very base levels of poverty. And in Latin America, it's estimated that 24.7%, so just less than a quarter of the entire population, are still living below the poverty line of $4 per day based on purchasing power parity. That is a poverty line that has been established for upper middle income countries and therefore is appropriate for much of the market. It's a very large number. I'd also like to point out here, this bottom line, that despite some shrinkage over the period between 2013 to 2016, growth in microinsurance premiums has actually proved fairly resilient when compared to the premiums for the insurance industry as a whole. What do I mean by this? For traditional insurance industry, total premiums, annual premiums, shrank by 5.13% per year between 2013 and 2016. Whereas microinsurance premiums over the same period shrank by 3.64%, both in US dollar terms. So bearing in mind that currency effect. Moving on now to the methodology that we used for the study, I'd like to just start with a bit of a definition. And begin with the criteria that was used to select which products were included when companies were interviewed. So for the purposes of this research, the criteria were that these were products that were developed specifically for the low-income population, that are managed on risk-based principles and are affordable. And on the right-hand side, here is an example of what is meant by affordable. So for life and accident products, the percentage of GDP per capita that would be the top threshold of the premium that would be paid on what would be defined as a microinsurance product would have been $61, or about 191 pesos per year. For health, the percentage of GDP per capita goes up to 4%, and for agricultural and property insurance back down to 1.5%. So that gives a bit of a financial hard stop, if you like, in terms of what was included. Important to note as well that the products are designed with the intention of serving low-income people. Uptake may well be from other segments of the population, but that would not have been the core intention. In terms of the methodology used, this is a very primary research-intensive project, which involved efforts to interview as many insurance companies as possible, and also, very importantly, the collaboration of the 16 aggregators in the region who are mentioned at the beginning of the report. I won't name all of them by name, but we certainly are very dependent, and increasingly so, on the role that is played by national and regional insurance associations who collect the data from their members. That said, it can be challenging. Insurance companies and insurance service providers along the value chain are increasingly less willing to provide this sort of information, but at the same time, it's information that is needed in order to provide the benchmark for driving the market forward. So that is very important. What is also important is that regulators increase and expand their efforts to collect this type of data, and that a consistent definition across different countries and across different regions is used, and that is clear and transparent. In some instances, we've seen that the creation of a specific regulatory framework can actually make it look as though fewer products are available on the market, depending on the parameters that are set within the regulations, but more on this later. So we used secondary research along with the primary research. We used regulators' data where that was available, and there was extensive follow-up by email, phone calls, and even in-person visits. In total, 58 companies reported data, of whom 41 were identified as microinsurance providers, and 27 microinsurance providers also facilitated data. When we refer to comparable data in the report, and this is an important point, we're talking about companies that reported data both in 2013, or the study that was published in 2014, and also, again, for the study that we're releasing today, so the one that you have in your hands. So what has the change been as we move now to see what the key findings are of the report? You can see that there's some good news and some bad news. So the good news is in red and the bad news is in green. What is seen as bad news may not inherently be bad news. This could simply mean that some clients have graduated to other products. We don't have this level of granularity of the information available. It's something that we're working on for the next iteration of the report as we take a view of potentially changing the methodology that is used for this year's report. But as you can see, where there was growth, there was some pretty significant percentage growth. And this chart is based on what I've described as the comparable data, so like-for-like information, which includes companies that reported in both years, as well as new entrants to the market. You can see the good news is that life insurance, this is talking about coverage in terms of the number of policies, has increased by 23%. Property has gone up by an incredible 633%, and agricultural insurance by 132%. Where there have been declines has been in the case of credit life, accident, and health insurance. that would be micro health insurance specifically. What about the business case and market size? So on the left-hand side here, you can see that the relationship between gross written premiums for microinsurance compared to traditional industry premiums, and you can see that there is incredible variation, as mentioned earlier, between the different countries in the region. So greatest penetration of microinsurance relative to traditional insurance in the region is in Ecuador. Colombia, you can see here, in the top 5, followed by Peru, and then very, very much smaller as you go down the chart. On the right-hand side, you can see the share of premiums by primary cover, by type of insurance. And I'm sorry, some of the icons have gone missing, but you can find the same chart in different colors in your report. And you can see that life is still the dominant product type. This could be driven by the fact that the combined ratio for life cover is in fact a lot lower than for all products combined. We'll see that in this chart. So if you look at the bar, the pale beige bar on the top, that is the difference between the total premiums and the costs that are included in the blue segments. So there is a need to improve on a number of things. So the fact that claims are high is not necessarily a bad thing from the point of view of an insurance market and development. In order to develop the trust of emerging consumers in insurance products, it's very important that they are able to make claims and that they are paid out for the product or service that they believe that they have bought. So we see this around the world, and a number of forward-looking mainstream and niche insurers are looking at the need to accept that certainly in the early years, it's very, very important that clients understand clearly what they have purchased, and that when they make a claim, it is processed very efficiently. And this is a role where technology and insurtech, it's an area where it has a very large role to play in terms of facilitating the very rapid payout. And again, estimates of how long these payouts take can be a matter of, in some cases, from 1 day, right, using typically mobile technology to do the payout, to as much as 90 days. For a person who is very poor, 90 days can be the difference between survival and maintaining an activity and falling back into that poverty trap. So speed is important. The other thing that is important, of course, is that claims ratios are going to vary by product. If you think about funeral insurance, I think the point is fairly obvious that someone is only going to claim once. Whereas for products such as health, you would expect to see ongoing claims. And in many areas around the world, what we're seeing is added value. So it's not just health insurance that's being sold, but also access to medical advice and services that would reduce the health risks, if you like. And we are seeing that in the low-income markets, just as we've seen it in higher-income markets as well. So from this, you can see that essentially the key takeaway would be that life remains the most profitable product type, hence perhaps its huge share, although the share of other products is increasing. Here a bit more detail about the claims ratios and the point that I made about the variation between them. It would also be important to point out that the claims ratios here show the difference between product type, but there, even within a product type, there are huge variations per product, which speak to a number of things. So it can be whether or not the client understands that they've purchased the insurance and they therefore can claim when an event takes place. It can also be whether or not the insurance is appropriate. So if you think about index-based insurance, is the threshold set so high or so low that it's very unlikely that clients are going to be able to claim? That's another possibility, right? Depending on the philosophy behind the insurance. If it's for an extreme event, then that would be appropriate. But here you can see a very huge difference. We also found that I talked about the difference between products within a certain category, and that variation you can see in the difference between the median that we show here and the mean, the average. So the median refers to half of all the products that we're reporting, whereas the average would be simply the arithmetic average, the mean. And the aggregate here refers to the premium weighted average. So what are the market trends that we see? More than half of microinsurance providers who took part in the survey claimed that they track financial key performance indicators, or KPIs, but despite this, only 10% or less said that they actually account separately for microinsurance expenses and expense ratios. So there is clearly a bit of a dislocate here, and more work to be done on that. And again, this is something that as the Microinsurance Network, we're looking at how we can improve the understanding of how to improve these products and these KPIs to ensure that value is delivered both to service providers but also to customers. Other trends, we see with respect to InsurTech that the Latin American region is actually lagging behind other regions in the implementation of mobile technology, which could and should be used to reduce administrative costs. Part of the reasons for this is our history. So we've seen a huge uptake of mobile payment systems in Africa where there was a leapfrog effect. It was partly driven by the fact that there was so little access to formal financial systems and such low access to banking that there was actually a lot of room for this new technology to take place. And in many instances, it took place because there was a regulatory gap. And there was nothing saying that the progress or the new technology or the innovation couldn't be implemented, which made it possible for it to be implemented. And a case in point is M-Pesa in Kenya, which I'm sure many of you are familiar with. The mobile technology can be used to reduce administrative costs in a number of different ways. And I would encourage you, if you're interested in this, to look on our website where we have a whole series of meetings and events and also research available on this subject, notably the consultative forums that we organize between the private sector and regulators and supervisors around the world. The other key trend that we looked at in the market was distribution channels and commissions. So we do see in Latin America that, although it's true to say that distribution channels vary by product type, what is especially still true here is that it's financial institutions that dominate. So we're not seeing a huge move by MNOs or others into this space at this point, unlike what we're seeing in Asia and the African region. Also, what we noticed, taking into account a very small sample size, is that there is enormous variation in commissions. So, and there's also very little data other than what we were able to gather. There's very little data on this. It's not clear whether it's being collected or whether it's just something, an area where there's a certain resistance to shining a light. So commissions are important. Everybody, in order to make a business model sustainable, that means that people participating all along the value chain have to extract some value from it. But what is interesting is the variation in commissions. And it's thought that one explanation for this could be that In some instances, only a couple of service providers are able to handle the large volumes that are implied through servicing microinsurance products, because clearly this is a volume business. So that is something to be explored. What more can be done to develop the market? So this table shows the perspectives of providers who were interviewed, both for this study, but also for the same study that was done in the Latin American region 3 years ago, and in Africa in between. And what is striking is how little has changed in the Latin American region, and that what remains the number one priority is the need for market education and financial literacy efforts for consumers. Something that needs to be taken into consideration here is, to what extent is this the role of NGOs and not-for-profits such as ourselves? To what extent is it the role of the industry, whether through industry associations or not? And to what extent is it the role of the insurance providers who are trying to sell products, or the brokers who are the financial intermediaries? We see different models around the world. Again, this is a topic that we're exploring. It goes hand in hand with the need for consumer protection, consumer financial literacy more generally, but it is an important topic, and one where it's not enough to say, well, we invested a lot in promoting financial literacy, but we don't see a lot of results. One of the things that we're keen to look at going forward is, well, what are the best practice models for ensuring that the financial literacy efforts actually have traction and show results? The second most important input for this region that was cited is more favorable regulations. So there is clearly a need for a regulatory space that provides an enabling framework. One of the topics that was mentioned in Lima last year at the International Microinsurance Conference in November was the need to allow paperless transactions and processing. This is terribly important to the microinsurance market because of the need to reduce costs, administrative costs. Another area that is important when it comes to regulatory frameworks is the possibility of having proportionate regulations with respect to microinsurance. Another aspect would be the coordination between different ministries or different regulators. Is the telecoms regulator talking to the insurance regulator or to the health regulator? How is regulation developed? It takes a long time to develop a regulatory framework. So having the opportunity to implement what we might call a sandbox approach, or pilot schemes, or a safe space over a period of time for testing different approaches, could be another way to tackle the problem. But what is most important is that there is two-way dialogue between regulators and industry, that industry takes regulators along the journey so that they can actually overcome this learning curve, understanding that many regulators have severe resource constraints. There may not be many people, and there may be a shortage of funding to facilitate learning. And on the other side, technological change is important, and it is happening faster and faster. But the truth is that we do need to take people along on that journey. There certainly needs to be an amount of patience, and there needs to be a way also to understand that industry should understand the importance of consumer protection and the role of regulators and supervisors in ensuring that that happens. And then, of course, we move on to the third input, which is more or better distribution channels. And I think that a valid view here would be that if there is a market to be made, we will see players entering the space. If the perception is that there is not a market to be made, then there will be an absence of entry, or at least it will be hard to find a sustainable business model. So coming now to the status of regulatory frameworks in the region, again, you can see quite a lot of variation. The red, the countries shown in red, again, you have this map in your report, are countries where there is currently no microinsurance regulatory framework in place, nor are there studies on the microinsurance market. Now, let me preface this and remind you what I said about Africa and the development of M-Pesa. The fact that there is no regulatory framework does not mean that there is a market. Normally, a framework is developed because there is a response to a perceived need on the part of the government. It could be that existing insurance laws are broad enough that they make it possible. They don't stop the development of a microinsurance market. So it doesn't mean red doesn't mean bad, it just means different, all right? In the countries which are shown in dark blue, so you can see Brazil, you can see Peru, there is currently a specific microinsurance policy regime in place. The countries shown in turquoise there is currently no regulatory framework in place, but work is in process. And in the pale blue countries, nothing in place, but there are plans to develop one. So again, quite a lot of variation. For more information, in-depth information on the regulatory framework in each country, I would refer you to our sister organization, Access to Insurance Initiative, to their website, A2II. They are the gatekeeper for many of these policy documents. So moving now with just a little focus specifically on Colombia, since we are here today. I thought it would be interesting just to look at the Colombian market with a few key facts. One of the things that we're considering for the next iteration of the next series of studies is more of a country focus. But what I thought was quite interesting was to take a bit of a stand back. You won't find some of this data in the report because I've done it fresh for you here today. But if we consider that microinsurance targets this market of what the development banks might call the floating poor, what insurance companies might call emerging customers, what we wouldn't refer to necessarily as the bottom billion, but we might refer to as the next bottom billion, or the missing middle, if you like. We're looking at people who live on between $190 and $4 per day in purchasing power parity terms. Obviously, there are variations, but it's a useful. These are useful thresholds to employ when you're trying to size what the potential market for microinsurance could be in a given country. And what we see is that in Colombia, that market is an estimated 22.6 million people. We know that average household size in Colombia is about 3.9 people, so extrapolating from that and extrapolating what total coverage would look like if each household had a policy for each product type based on threshold premium, the full market potential in Colombia can be estimated at around $2 billion. That is not an inconsequential market. And it's perhaps surprising that change has been so slow. So I'd like to leave you with that thought today that there is still tremendous scope for reaching the poor with good insurance products in a country like Colombia and in your neighboring countries. There is a good business case for insurance companies. It's important that that case is good. It's important for that case to be sustainable, that the products are appropriately designed for the low-income households that they're intended to serve. And for that to happen, it's important to understand the needs of these low-income consumers and not assume that their needs are simply as our needs might be, but less expensive. So affordable does not mean just cheaper, it may mean different, and that may require some upfront investment. But with markets this size, I feel confident that over the medium term, that will pay off. I seem to have lost a slide, but okay. Right, I would like to thank you, but I would also like to issue a little call to action, which is on the missing slide. So I'll just speak this one to you. So getting product design right is absolutely key. And as I've said, getting right means value added for service providers as well as in consumers. Insurers, you need a better understanding of emerging consumers so that you can design products that will result in higher uptake. Poor people are poor, but they are probably better judges of value than many of us who have to be less careful with our money. Lessons on improving or reducing administrative costs, so improving the administrative burden, can be learned from other regions, even regions that are poorer than your own. And that will help to improve fair profitability. Proportionate regulation can help to provide an enabling policy framework, but more can certainly be done in terms of requiring appropriate reporting from companies that sell these kind of products, because without this, it makes it very difficult and expensive to track market development. So my last thought to you all is that the opportunity to do well by doing good is huge. Don't miss it. Thank you very much.